non-UK company pays a UK property rental and IRS receive property income are subject to UK income tax based on a rate of 20%. Okay, good stuff.
Yeah, we gotta find what a proper rental.
Property rental.
Yeah, in the UK, owned by a Bahamas IBC. He just recently sold it. And now it makes sense because, you know, they used to complete these forms for HMRC. And then do all these calculations and that I need to go look at them, so it could, when I read this, it could sink in my head.
See, you practice it. So,
Yeah.
So
That's why I tell you,
imagine-
theory is so different from practical, and I think that's why, writing is different, because when he show you this in theory, but and then he tells you practically, so you could relate. So
Yeah.
just read it from
So
there.
because you working in it, it's more familiar.
Yeah,
Yeah.
but I tell you, like, theory, trust
trust.
theory and practice is so different. The theory is only to get designation, but when you go and practice, totally different.
Totally different.
I mean, even though the concept, but the stuff you read on, like, you know, book, like, you know what I mean, you can't say, oh, I'm gonna refer to the book to see what it says first, no.
No, okay. You just gotta know your stuff.
Understand the trustee, understand what it is they asking you to do, understand who has the power to do it, understand what documentation you need to do to, you know, to
Get it
execute
done.
it. You don't need no steps for that, you know what I mean?
No, you just gotta read it.
Exactly, it's
Certified.
just getting
Yeah.
certified.
And
All of us had that
When
thing.
I first started.
hello, everybody. Good evening.
I tell her she drank like everybody else. Rough day. Sign in.
This is a short.
Yeah, this is shower. They told me 7:15 they won't be out of here.
I agree.
Yeah. What is here? Who come late?
You finish with the sheet?
And taxes are very complex topic. And I think I even get tax advice, so the developers will just, see no joke.
Well,
Yeah, you're making the money, like, tax lawyers and tax
Mhm.
lawyers, they no joke.
Yeah.
Very complex.
because it's changed, because you see this.
Yeah.
And then these people have access outside different jurisdiction, like the law applies for
That's
what,
what it is.
that's what it is.
That's what it is. When you start mixing up them right in jurisdictions.
You got to know.
Mm-hmm.
That's why we say, you don't give legal and tax advice, go pay the big boys, come back to us. Then you will know how to structure, how to unwind them or whatever. So you gotta try to make it more money. I need a Myron tax. I could be a housewife with you.
You won't see him, because you'll be a housewife.
That's a serious thing.
Yeah, yeah.
When you marry two persons like that.
And Jack was in his house and stuff like that. Yes.
Everybody did.
One got 50 grand for one little
People.
couple pages, so you put together with his opinion. $50,000.
Wow.
They make him a rich boy when he got money, he asked his spread on, look that up.
Yeah.
Pay.
Because then you can't share the information
Exactly.
with which one.
Mhm. it was here, right?
Yeah. This is the only thing we get, so this is not, this is not.
That was the information. That was a lot of information.
I was really professional.
And stuck.
And then the next line, we should switch to thinking something.
That's from 3 seconds.
And then auto will come up
So you have to really know what it is. You have to really know.
the last one, implemented that. Well, this is like one time machine. I was done with the HMR or something.
There was a lot of how much she
No, we had a jump drive.
A jump drive.
She gave us a jump drive.
What? A
Last
jump drive.
A jump drive.
She was seeing the sun most of it. Questions came from her.
From the jump drive.
Yeah, because that's what the time was telling you, most of the questions came from
The jump drive.
Jaiva. They just were being in hand.
They pulled it from.
So it means you just come and those slides should tell you to look.
Yeah,
Yeah, you finish. If you only have text, then you should be able to stop.
Oh.
Good evening. I was only pulling your leg. I told him, I say, long night. It's like growling. I don't know what that means. Man, it should be like easy peasy Japanese, huh? You have more paper to give us? Last you see me no more. This is the end.
We got give them the jump drive.
This is the end.
What are the
See me no more. I'm gonna be like the vanishing genie. Disappear in a second. Not long.
It's Christmas time.
Finish a couple minutes.
Your jacket's on. You need hot, you need hot, and you basic.
Why?
Let's go. Let's do this.
Let's be ready to do this.
Say
Say what? All right. How offshore trusts are taxed? So, we live and we work in an offshore jurisdiction, so I don't need to tell you what is an offshore trust. And normally what is there for people who don't work in the industry, and so normally they'll ask, what is an offshore trust? How is it different? Just said, that listen here. Then I have what are non-resident trusts. Any questions there?
This is non-resident trust.
Don't try it.
I'm the only one that do not want to live in
You
this
wait to the
town.
Department of Inland Revenue to figure it out.
Use the trust
We don't do no
experts.
trust.
I mean, a tax
I ain't compliance.
We ready? Okay, let's
It's
talk
the
about
section in the class exam.
inheritance tax and trusts.
Where you reading from?
It's like number
Page 5.
Let's go. That's your business, you didn't pick up your handouts.
You take too late to give it, you know, I just leave quick.
Was she not the last person to leave?
No.
No.
She was the first?
Twice.
Well, you miss out.
After you give her a headache at that boy.
So here I just give you a little blurb about discretionary and accumulation trusts and income tax. Trustees are responsible for declaring and paying income tax on income received by the trust, and they do this on Form SA 900, Trust and Estate Tax Return each year. In both discretionary trusts and accumulation trusts, income is taxed at the special trust rates, apart from the first 1,000 of trust income, which is known as the standard rate band. If you look below, you'll see we have the trust income up to 1,000 and then the rate over £1,000. You remember that, right?
Yeah.
Okay.
Good stuff.
However, if the person who puts the assets into the trust, the settlor, has more than one trust, the 1,000 standard rate band is divided by the number of trusts they have. If the settlor has more than 5 trusts, the standard rate band is 200 pounds to each trust. If the trust is a settlor interested trust, the settlor is responsible for income tax, even if the income is not paid to them. The income tax is paid by the trustees as they receive the income. And I gave you the chart for up to and over. Those are the rates.
The standard rate band, is, what is that again, is that 30%? Oh, up to 1,000, okay.
And then over 1,000. Discretionary income payments to beneficiaries. When trustees make a discretionary payment of income, it carries a tax credit at the trust rate, currently 45%. This means it's treated in the hands of the beneficiary as if income tax has already been paid at 45%. The beneficiary must be able to claim some or all of the tax back if they're a non-taxpayer or 20 to 40% taxpayer. Trustees of a discretionary trust or an accumulation trust, where they also have the power to make discretionary payments, need to make sure that they've paid enough tax to cover the tax credit to the beneficiary. They do this using a process called the tax pool, which keeps a record of all discretionary income payments made by the trustees and the tax the trustees have paid. I didn't go this time in showing you all how the actual trust pool work, because if I do, they will examine you on a tax pool.
Thank you very much. Yes, you killed some people the last time.
Yes, I actually showed them how the tax pool work.
And they did it, brought it.
Yes, they would bring
And
it,
I made it.
except for inland revenue.
I made it.
Wow.
They brought it.
Yeah, so I didn't do the tax pool. This can get real complicated. Capital gains
So you
tax.
decide what they test us on?
Yeah.
So why you give us all this paper?
You know, right? I just catch
Bring my jump
myself.
drive for her, you know.
So she could see
Yeah.
how much more you all have.
Yeah. Want me to bring my jump drive for you?
No, she don't want to see that. We will, no, it will make it money.
Because it was so difficult for people to pass, and then I made it less, but I can't make it so much less, because they're gonna write back, and they're gonna say insufficient data.
Yeah.
But she'll tell you, I give them breakdown of different trusts, and how to tax different trusts. More calculations.
Thank you very much.
How is it summary?
Huh? No, I can give it to you again.
No, John.
Whatever she brings, they can put it.
So capital gains tax is a tax on the gain in the value of assets, such as shares, land, or building. A trust may have to pay capital gain tax if assets are sold, given away, or exchanged, and if they've gone up in value since being put into the trust. The trust will only have to pay the tax if the assets have increased in value above a certain allowance known as the annual exempt amount. Trustees are responsible for paying any capital gains tax due. Beneficiaries aren't taxed on any trust gains and don't get credit for any tax paid by the trustees. Now she could tell you, I could have actually gone and give you the whole capital gain structure
Yep,
and how they pay that on a trust.
yep. Time.
Disposal of assets into trust is chargeable disposal for capital gains tax purposes. As the settlor is deemed connected to the trust, any proceeds would be deemed equivalent to the market value of the assets transferred. As such, it would not be possible to avoid capital gains tax by gifting the assets. From a capital gains perspective, the most effective way of establishing a trust would be to invest cash, and then the trustees invested in accordance with the trust deed. This would fall outside the scope of capital gains tax as the asset gifted is cash. Another way of establishing a trust is to settle assets which have a low initial value with the expectation that it will grow. The growth would be offshore and then would be subject to anti-avoidance rules. because it's outside of the UK capital gains tax regime. So let's go. Barry is considering purchasing a share in a small South African mining company for $50,000. He's hoping that the mines will strike gold and the shares will rocket in value. Rather than purchase the shares in his own name, he goes to his attorney and forms an offshore trust into which he settles the $50,000. The trust purchases the shares in the South African company. When the shares in the company increase in value, what will be the applicable taxes? Tax rate.
See what I mean, it's tax free. Read up on it in my head.
I thought the question come in.
Mm-hmm. So my question is, when is capital gains tax payable? Can I give you the answer? If assets are taken out of the trust, who pays? Mhm. And then there's a fair trust. If the settlor is domiciled or deemed to be domiciled in the UK, when the trust was set up, the trust is subject to UK inheritance tax. A transfer of assets to a discretionary trust is called a chargeable lifetime transfer. The available nil rate band remaining is deducted from the value of the gift, and tax is payable at 20% or 25%, depending on whether the trust or the individual is to pay taxes. So taxing the assets of a trust occurs when assets are transferred into a discretionary trust, taken from your estate and therefore are not subject to inheritance tax, along with other assets you may own. Inheritance tax consequences are that effective rate of inheritance tax is calculated based on the initial value of the trust, taking into account previous transfers. When assets are distributed out of the trust, and on the 10th anniversary of the date the trust was set up, inheritance tax is payable on the amount distributed for the trust assets. So Paul is of Italian domicile. He's moved to Britain to expand his business into the UK. He has substantial assets in Italy and wishes to protect these from inheritance tax. How should he set up his financial affairs in order to pay inheritance tax? Okay, so you can set up an offshore trust, right? And then the offshore trust will be outside of the UK inheritance tax. So what if he acquires UK domicile later?
Subject to, UK taxes.
He will be?
It's already set up
He's
offshore.
already set up offshore.
Okay, all right.
So a discretionary trust is free from inheritance tax in two circumstances. One, where the trust is within the settlor's nil rate band and remains within the nil rate band for the following 10 anniversaries. That's the 325.
That's a long time.
Yeah.
The following 10 hours.
Uh-huh. The second is circumstances where discretionary trust is free of inheritance tax, where the assets transferred into the trust are covered by an inheritance tax exemption. And for example, is the business property relief. The business property relief, full or partial exemption from inheritance tax where business assets are gifted as shares of commercial property. And to claim, there are other conditions to be satisfied. So there are many advantages to using an offshore trust. However, trustees have to be aware of how the anti-avoidance rules impact offshore trust. So to shelter the income and gains through the use of an offshore trust, there are two obstacles. One, tax and avoidance legislation which attributes income to the settlor, and the anti-avoidance legislation which attributes gains to the settlor. So, in summary, the benefits of offshore trusts are no UK tax on overseas income, no UK tax on any gains made, either in the UK or offshore, no UK inheritance tax in certain circumstances. Other benefits are privacy, ring fencing assets offshore from potential creditors. But the HMRC has a number of anti-avoidance rules to prevent a person from enjoying tax benefits.
7:30 to 7:31.
Yes. There are various rules which apply to offshore companies. So income tax, section 20 to 731, which provides for wide-ranging anti-avoidance powers designed to prevent anti-avoidance of income tax by individuals using offshore trusts and companies. So even though I've given you the slide for companies, they all fall under the same section. So the conditions for applying section 720 and 727. 1, there must be a transfer of assets by an individual. As a result of the transfer, income becomes payable to a non-resident. The transferor must have power to enjoy that income in some way or receive or be entitled to receive a capital sum. The transferor must be ordinarily resident in the UK in the year of liability. That's how they catch you. If all the conditions are met, income payable to the offshore trust is deemed to be that of the individual who made the transfer, to the extent he has power to enjoy that income. The next point is to consider is whether there would be a transfer of assets to settlor. So section 720 may apply where an individual transfers cash to establish a non-resident trust, or he subscribes for the share capital of an offshore company, where an individual transfers assets such as shares or property to a new existing non-resident trust or other person abroad. Intangible assets are transferred, for example, a service to an offshore company or trust. Section 720 does not apply where an individual transfers assets. It applies when an individual either transfers or is associated with transfer of assets. If the operations were planned as a single structure, they could be associated. So what is associated? The law tells you what that means too. An operation of any kind affected by any person in relation to any of the assets transferred, or any assets representing, whether directly or indirectly, any of the assets transferred, or to the income arising from any such assets, or to any assets representing, whether directly or indirectly, the accumulation of income arising from such assets. Basically, it includes any actions carried out by the settlor in relation to the trust assets in connection with the generation of income arising from the trust. That's all it means. So section 720. If the conditions in section 720 are satisfied, any income arising to the non-resident trust can be taxed pursuant to that section, whether UK source or foreign source income. Note that one of the conditions is that the UK resident must have power to enjoy the income arising to the non-resident. Even if you did not actually receive any income from the trust, it is the potential to enjoy the income that's important. You will have to receive no income to avoid the income being taxed to you, as long as you enjoy it. So section 731. This applies where assets are being transferred abroad and a UK resident other than the settlor obtains a benefit. And there are 4 conditions to be met. 1, there must be a transfer of assets. 2, as a result of which income becomes payable to a non-resident person. As a result of the transfer, an individual other than the transferor receives a benefit, which is not otherwise chargeable to income tax. And 4, the recipient of the benefit must be ordinarily resident in the UK in the year of charge. So the difference between section 731, 720, and 727 is that 731 taxes non-transferors on benefits received. Benefits chargeable include payments of any kind, use of property, interest-free loans, cash. Where the conditions are met, the individual receiving the benefit is liable to tax on the amount or value of the benefit. Section 731 charges the amount of value of the benefit received to the extent that it is matched by the available relevant income of the offshore trust or company. And then the Act actually defines what is relevant income. Refers to the income that arises to the offshore trust, which can be used to provide a benefit for the beneficiary concerned. For example, rental income received by the trust. If there is any relevant income in the trust and a capital distribution is made, the capital distribution could be taxed on the UK resident beneficiary as income to the extent of the relevant income. So section 720 and 731 are the main anti-avoidance rule and will catch many UK residents. So there are two ways of capital gains tax and avoidance rules can apply to offshore trusts. Settlers of offshore trusts can be attributed capital gains of that tax. Beneficiaries of offshore trusts who actually receive capital payments or distributions from the trust can be taxed on the capital gains of the trust. So the tax charge on settlers. This provision attributes capital gains to the settler of a trust if defined people are actual or potential beneficiaries or receive a benefit. And they actually tell you what is defined people. The settlor, his spouse, children, the children's spouses, their grandchildren, and their grandchildren's spouses. Also include a company controlled by a settlor or one or more of defined people, or of a company associated with a company controlled by the settlor. You see how wide their definition is? They make sure they capture anybody who's associated or benefit from it. These gains are treated as forming the highest part of the amount on which the settlers charge capital gains tax in a year. This means that a newly formed offshore trust would only operate as a capital gains tax shelter if the settlor, his spouse, and grandchildren and their spouses are excluded from the trust. Beneficiaries. These provisions catch gains realized by the offshore trust which are not assessed as the settlers under the aforementioned rules. So how does it work? The non-resident trust each year should make an assessment of its trust gains for the year. These are treated as accruing to the beneficiaries who receive capital payments in that year. If the trust gains exceed the current and paid capital payments, they are simply carried forward. The main effect is to treat trust gains as the gains of beneficiaries, but only when they actually receive benefits from the trust. And that's what they call the remittance basis. Capital payments does not apply to a transfer of cash from an offshore trust. I told you that earlier. But includes the transfer of assets from the offshore trust, interest-free, low-interest loans from the trust, as well as occupation of trust property at a below-market rental. There is an exemption which excludes gains from economically significant activity carried on outside the UK and broadly that's goods and services on a commercial basis. The general motive exemption for gains on disposals where neither the disposal of the assets nor the acquisition or holding of the asset by a non-UK company form part of a scheme or arrangements to avoid capital gains tax or corporation tax. This exemption should include a local company set up to acquire foreign real estate. So look what I give you, a nice little chart. Certain people know this chart.
Yes, yes, certain people do this chart.
Settler
Yes.
interested trust, who will be taxed? I would suggest you memorize this
To your heart.
to your heart.
We could just bring this in. Say what? This is it?
I have a longer version.
Yeah, I know.
Yeah, I have a longer version.
I'll carry this page. So hold on, what?
Yeah, because what I did in the last, how many times? When did it this? 3 years ago?
3 years ago.
3 years ago. So for the last 5 years, I would actually take the different types of trusts, and then under each trust I put whether you're an individual
I feel so proud.
or a settlor, and then I would actually put whether or not they have to pay income tax or capital gains tax under each structure. And they would test you on each one.
You give it to them?
Not for this one.
That was our study guide.
I had my own. I had my own drawn up and I gave it to them.
So now I'm gonna learn it does, right?
Of course, what, my own? No, I didn't send that.
Okay.
I just put this in it
Only
instead.
just this, okay.
Yeah.
What do you come around this? What do you work around this?
So non-domiciliaries. From 6th of April 2017 and offshore trust from the 6th of April 2018. There are some changes.
Next page.
Next page.
Also, you only doing page order.
No, you can go to your chart. The chart is just a repetition.
You ain't gotta go get that, just say you got paper over to bring it up.
She said memorize that.
April 6, 2017 materially increased the exposure of many non-domiciliaries to UK income tax, capital gains tax, and inheritance tax. The value of interest in offshore closed companies and partnerships so far as attributable to UK residential property will no longer be excluded for UK inheritance tax. There will be a substantial changes to the tax treatment of the beneficiaries of non-resident trusts from the 6th of April 2018, which will affect UK domiciliaries. Because they've been having a lot of discussion in their UK finance bill in order to meet their local commitments, and they're finding different ways to tax in order to meet the income budget. So deemed domicile from April 6, 2017, anyone actually domiciled outside the UK who has been a UK resident for at least 15 of the 20 preceding tax years will be deemed UK domiciled for income tax and capital gains tax. So even though you left the jurisdiction, yes, you'll be taxed. Anyone actually domiciled outside the UK who has been a UK resident for at least 15 of the 20 preceding tax years and for at least one of the 4 tax years ending with a particular tax year will be deemed UK domiciled for inheritance tax purposes in that year. Furthermore, anyone born in the UK with a UK domicile of origin who has acquired a new domicile elsewhere will be deemed domiciled in the UK in relation to a tax year for income tax and capital gains tax if they are resident for that year. And for inheritance tax if they are UK resident for that year and were UK resident for at least one of the 2 preceding years. So you see how they widen it?
Swiss nationals now have been moving to the UK as UK non-doms, and what they've been doing now is restructuring, like selling any property they have, so that basically they say if they receive assets, while they move it, they won't have to pay tax on them, because they have this window. So we noticed like an influx of them just moving to the UK as UK non-doms, but it's whole tax avoidance.
Yeah.
A whole slew.
And they move from jurisdiction to jurisdiction as the laws change.
Wow.
Mhm.
But it's killing us.
Yes,
Yeah, it is.
it is.
Yeah. We know a lot of business.
So double tax treaties may apply and could have an impact on this. The new deemed domicile does not apply in every circumstance. Thus, a resident, but actually a non-domicile beneficiary, receiving a capital payment from a non-resident trust will continue to enjoy the benefit of a rebasing election by the trustees as of the 5th of April 2008 after the 5th of April 2017 unless he was born in the UK with a domicile of origin within the UK. There are special rules for those who prove to be temporarily non-resident, which generally means non-resident for an interval of fewer than 5 years. For example, if the year of return is 2017-18, the new deemed domicile doesn't apply for that year. All non-doms should review their period of UK residence to identify when they will become deemed domiciled if they have remained UK resident after April 2017. Trust created by a non-domiciled individual, unless born in the UK with a UK domicile of origin, can remain protected from inheritance tax to the extent that the trust assets are non-UK situs, this means it's not located in the UK, despite the settler being deemed domiciled. Trust created by a non-domiciled settler who was born in the UK with a UK domicile of origin will lose excluded property status when the settler becomes deemed domiciled for inheritance tax. A change which affects all non-doms, not just those who become deemed domiciled, is that interest in closed offshore companies and partnership, unless under 5%, are subject to UK inheritance tax, to the extent their value is attributable to the UK residential property after April 2017. Inheritance tax. Loans made to individual trustees and partnerships to finance the acquisition of UK residential property, directly or indirectly, and money or money's worth made available as security collateral are subject to inheritance tax. When such interests in companies or partnership are disposed of or such loans repaid, the proceeds will continue to be subject to inheritance tax for 2 years. Those affected should review the potential inheritance tax liability and consider the taxes of developing. When interest in offshore companies and partnerships owning UK residential property and associated loans cease to be excluded property, there will often be a reservation of benefit therein by settlers of discretionary trust from which the settlor may benefit. There can also be a liability to a pre-owned asset charged on the settlor in case of certain settler interested in possession trusts.
Might as well just say everyone just pay.
They just pay on everything no matter what.
Everybody gotta pay everything, that's it.
Okay, so those domiciled, those non-doms who become deemed domiciled in 2017 because of the 1520 rule, remember the 1520 rule, you did it with the other trust, and not because they were born in the UK with a domicile of origin here, and who are paid the remittance basis charge as long-term UK residents for any year up to 2016-17 will be deemed to have acquired, as of 2017, at market value, all of their offshore assets held on that date that were not situated in the UK at any time in the period beginning in March 2016 and ending 2017. This would include not only assets on which a gain subject to capital tax arises, but also gains realized on interest in non-reporting offshore funds that are subject to income tax. This will only apply if the individual became deemed domiciled in the UK in 2017 as described and remains so for all tax years up to that in which a disposal occurs. So you think we should do like that in the Bahamas, eh? All those born in the Bahamas and lived in the Bahamas in the last 20 years should pay tax.
Agreed.
That's what they're doing.
Yeah.
So we're not asking you to come home, just pay your taxes.
That's like the 183 days rule.
Yeah.
That's the same thing.
Mm-hmm.
That's why people do 182.
Yeah. Individuals may elect for the rebasing not to apply to a particular disposal. For example, if there is an overall loss but a gain over market value, as at April 2017. If the assets were originally acquired with clean capital, it will be possible to bring the entire proceeds from the disposal into the UK without triggering a remittance charge. However, if it was acquired using previously unremitted foreign income or gains, an element of the disposal proceeds will still relate to such income or gains and will be taxed. Those affected should assemble details of assets affected. The treatment of the newly deemed UK domiciled settlers of non-resident trust changes, like I said, from April 2017. So before that date, UK resident but non-domiciled settler of a settler interested trust was not subject to capital gains tax on the trust gains. Instead, any UK resident beneficiary who receives a benefit from the trust that may be matched with trust gains may be charged CGT. This continues to apply if the trust was created when the settler was a non-dom, despite the settler being deemed domiciled after April 2017. but only if deemed domicile is on a 1520 basis and not because of being born in the UK with a domicile of origin. This protection continues so long as no property or income is added to the settlor or the trustees of any other settlement of which the settlor is a settlor or beneficiary at any time when the settlor is domiciled in the UK or deemed domicile. Additions made to meet expenses relating to taxation and administration that exceed the trust income are disregarded, but loans on other than arm's length terms can represent an addition to the trust, and of course you'll be taxed. Where the settlor is deemed domiciled with effect in 2017 and loans exist on terms that taint the trust, this can be avoided by action taken by the 5th of April 2018. Tainting is avoided if the loan is repaid together with all interest by that date, or the loan becomes an arm's length term, becomes on arm's length term by April the 5th, 2018, with effect from April 2017. There are further changes affecting beneficiaries of non-resident trusts that apply as from April this year. The first change is to disregard all capital payments to non-residents unless the recipient is a close member of the settlor's family. 2, the payment is made in a year. The settlement ceases to exist after the 5th of April. And the recipient is temporarily non-resident, in which case the payment is treated as received in the beneficiary's period of return to the UK. I wonder who's going home. Also to be disregarded are capital payments to UK resident beneficiaries who migrate before the payment is matched to trust gains. The disregarded capital payments therefore leave intact the pool of trust gains available to be matched with capital payments, where chargeable gains are treated as accruing to a close member of the UK resident settlor's family who is either non-resident or the remittance basis applies to the beneficiary, and none of the gains is remitted to the UK in a year, the settlor is chargeable the capital gains tax as the gains accrue to him. Settlor may then recover from the beneficiary or any trustee of the settlement the tax he has paid. What, close member? Close member of the settlor's family if the person is a settlor's spouse or civil partner, or a child under 18, or the settlor's spouse or civil partner.
You're recording distributions to him, one way, and they want us to, oh, that makes sense. It making sense to me
What?
now, so
Uh-huh.
we're going through the work with what you're saying,
Uh-huh.
because this particular client, crazy man. He moved to the UK, I think it was sometime last year, and he always wanted distribution. They have like this hotel in France or whatever, and then he into horses. So every time, he asks us money to pay those, they are not beneficiaries, so we treated them as distributions to him, not as a loan, and strictly from capital. They didn't say when we making this how to treat it. So of course this was going on for years, and now he's in the UK, still receiving distributions. Now he finally went and got tax advice, and all hell breaks loose now because they're trying to the document. It's just a mess because they know you have to pay tax. And it's a nightmare because his taxes pay on there in the millions, and so and so they now trying to like go back and see if we could redo the financials. And it's like really nasty. Yeah. It's a mess. I thought,
Yeah,
the Enron situation.
because he's the only beneficiary.
Well, during his lifetime he is. When he dies, then I
Oh,
think it's
so he's still living, so they
Mhm.
just move it from capital and put it in income?
Or treat them as loans. They're trying to freaking do that loans with percentage interest. You gotta make it look like it's a real loan.
It has to be around
Yeah,
saying.
exactly. So,
Oh my God.
yeah.
So how you gonna treat that?
Yeah. Well, the accountants and
Just wanna say,
his tax.
I mean, if you had other beneficiaries, that could not be done.
No,
no.
We see just getting last year, and this is
Yeah, but that's another thing, because the income has to match the amount of money that was
correct.
loans.
Yes, exactly.
Yeah, so how you gonna do that?
It's really not
Right.
good. It's really bad.
So he's gonna move up.
No, he's already taken up residence in the UK, that's why this.
So he has to pay,
That's why
he has to pay.
He has to pay. And now when they started to go through
Right, so they
over
tryna-
the years, it was never
Doing
clear
down
how
from
from
what
what
he
yeah.
trying to go right down.
Yeah,
Wow.
it's
Trying to pay us
bad.
less
We have
tax.
millions in
That's
pounds.
what- Which will still be a lot, so.
And he's still trying to sort this out
So
from
there's
last year. Because the
none of
documentation has to be in
The
place, because they have to
documentation
represent
has to
each and
match.
every.
Mhm.
to
And every
show
transaction.
everything. Exactly.
Yeah, because HMO.
Mm-hmm. Yeah, because the
Now
laws
they
changed.
can say- Yeah.
They discussed
Yes,
this
over
in
years,
2016. They put this in the draft finance bill at the beginning of 2017, and they passed this in 2017, and then they said it takes effect 2018. And for this year, they've already drafted another set of amendments.
Everybody's
There are
scurrying now.
two more amendments they've brought out now for UK domicile.
So,
Yeah, there's more. Because like I say, every time they have their, like, we have our budget, they look at where there are gaps, where they're not getting income, and then they amend the law, and they add more, and add more.
They could get on.
They get more and more and more. So if a capital payment is received from a non-resident trust by someone who is non-resident or remittance basis user, and is either not a close member of the settler's family, or the settler is non-resident, and after April 2018, while the original beneficiary has either remained non-resident or is a remittance basis user, the original beneficiary makes a gift within 3 years to a UK resident. The recipient of that gift is treated as receiving a capital payment equal to the gift. So you tax it. Income tax after April 2017, the settlor of a non-resident trust which may benefit the settlor was subject to income tax on the trust income as it arose. If UK resident but a non-dom might claim the remittance basis on foreign source income. If the property was settled when the settler was non-dom, and the settler is non-domicile or becomes deemed domicile under the 1520 rule, the foreign source income will, from 2017, no longer be chargeable on the settler, whether or not remitted to the UK, provided that no property or income is added to the settler or the trustees or any other settlement of which the settler is a settler or beneficiary at a time when the settler is domiciled in the UK or deemed domiciled. So the new amendments for 2018 have the effect of whether a non-dom has property in the UK. Because remember, you could have been a non-dom and have property in the UK but not taxed. So the two new amendments they brought out for 2018 going to 2019 is you're a non-dom, non-resident trust, but do you own property in the UK, you will be taxed.
No wonder we are applying some of their property, just moved to UK.
Yeah,
UK now.
yeah.
Before a certain date.
Yes.
Not making sense to me now.
But I didn't add that in here because there's two more amendments.
Yeah. Interesting.
So such income is termed protected foreign source income. A UK resident settler will remain taxable on any benefits actually provided to him of foreign source income. If benefits are provided to an individual who is a close member of the settler's family and the beneficiary is either non-resident or taxable on a remittance basis, the beneficiary is subject to income tax thereon. But if the settler is UK resident but not domiciled in the UK or deemed domiciled on a 1520 basis and a beneficiary is either non-resident or taxable on a remittance basis, the settler is taxable on the benefit. Because remember, when you benefit from it, then you're taxed. Until 2017, a UK resident individual might have been subject to tax on income arising to a person abroad under the transfer of assets abroad regime. From April 2017, this does not apply to protected foreign source income. It would seem that this treatment will not apply if the settler is entitled to income as it arises because he has interest in possession. A similar provision to that described above for onward gifts is to apply from April 2018. A very similar treatment is to apply to onward gifts from April 2018 under the transfer of assets abroad regime. Then I gave you the sources where I got these from. So now you see why everybody is moving and going to Dubai and going to Thailand, and they're selling here, and they're selling their properties.
A lot of people over the Thailand.
So even though we're trying to attract them to come here, I don't know how. The point is that you have to sell all your assets and come here.
But that don't make no
Who's
sense,
gonna do that? Who's gonna do that?
because even if you still put it in the trust, and still in the trust, it will be taxed.
All right, so let me tell you what an offshore company is now. It's a catch for everything.
Yeah.
So an offshore company is a non-resident company that is based in a low-tax jurisdiction. That's us. And I can tell you there are lots of articles and reports on the internet and how the House of Commons in the UK and other houses and committees say they intend to shut us down. They're losing income. So a non-resident company has tax advantages. A UK resident company is subject to UK corporation tax on its worldwide gains and income. A non-resident company is only subject to corporation tax on its income. So a company is regarded as UK resident if it's incorporated in the UK or its central management and control is in the UK. A non-UK resident company is exempt from taxes on capital gains, exempt from taxes on all foreign profits. So to obtain the tax advantage, you have to use an overseas company that is managed and controlled from the overseas. Did I just give you the different types of offshore companies? This is how they catch the companies. Because if your management and control is in the UK, it's a UK company, even though it's incorporated in another jurisdiction. So that's why they incorporate the company in an offshore center, and then they hire a nominee company to be the directors. Then I have other types of offshore entity. I have the bearer share companies.
Do we still have a lot of things?
No, we don't allow it.
No, we don't allow it.
No.
Yeah.
But there's some jurisdictions I see are still like behind, even though they changed their legislation to say no more bearer shares. Some of them have where you can still have bearer shares, but then there are requirements. So you, like Panama, you can still have it, but then there are conditions that the person who's holding it, that they have to meet. So there's still bearer shares. Then they have limited liability companies, then there are trusts, foundations, and protected sale companies. So what does Her Majesty regard as non-resident? It's a question of fact, where the company is controlled. HMRC divides a company's management into three categories: the management, the executives and senior management, and the long-term strategy, where they're governed.
The management replaces the directors?
Hmm?
Is that what they're referring to when they say management?
No, senior executives.
Executives and directors.
Executives are the directors and senior management. Okay, so I give you some examples where they don't consider a company to be UK resident. A company has more than one UK-based director on its board, but the majority of the board directors are based outside the UK, and the board only meets outside of the UK, and the directors do not travel but communicate electronically. A company has as main business the holding of majority shareholding in operating companies outside of the UK. The board meets outside the UK, and on the board is one or more UK-based directors, and the directors participate by telephone or over the internet. So what do they consider as non-resident? They have stated that it's not the number of meetings attended outside of the UK, but what happened at the board meetings. What is important is the location, where the management and the control of the company is carried out. So the best practice to establish a non-resident status: a majority of the directors of the offshore company are resident outside of the UK, normally in an offshore jurisdiction. The regular board meetings are held outside of the UK. Directors should attend board meetings and not by telephone from the UK. Directors should have the requisite skills and expertise. Directors should be familiar with the constitutional documents. Strategic decisions should be made at the board meeting properly convened, and the copies of all documents are kept by its registered office in the offshore jurisdiction. So there's some key provisions set out in section 720 to 731 again, designed to prevent the avoidance of income tax by individuals using offshore companies. And the conditions for application of these are the same as when I gave you underneath the trust. Transfer of assets by an individual. Result of the transfer income becomes payable to a non-resident. The transferor must have power to enjoy that income or be entitled to a capital sum. And the transferor must be ordinarily resident in the UK in the year of liability. And if all conditions are met, the income payable to the offshore company is deemed to be that of an individual who has made the transfer, and he has the power to enjoy that income, and so he's taxed. Section 720 can apply where an individual transfers cash to establish a non-resident trust or subscribe for a share capital of an offshore company, or when an individual transfers assets such as shares or property to a new or existing non-resident trust or company outside the UK. And if all the conditions above are met, any income from the non-resident company can be taxed by section 720, whether UK or foreign source. Then, I give you section 731, it's the same as what we did underneath the trust. And again, I give you the conditions. And I told you the difference here is that section 731 taxes non-transfers on benefits received. And then section 720 and 731 applies unless the person can show that exemption, and 733 applies, and then the two conditions must be met. It is not reasonable to draw the conclusion that the purpose was to avoid liability to taxation, and all the relevant transactions were commercial transactions, and that they were not to avoid liability. Section 733 can be applied where you carry on a business abroad, provided the use is commercial, and you can claim exemption from income tax avoidance rules. The apportionment of capital gains. This required gains of a non-resident closed company to be apportioned amongst the shareholders. The capital gains tax is charged to those shareholders who are resident. The amount proportion is determined by the shareholder's interest in the offshore company. Anti-avoidance rule only applies to shareholding of 25% of the shares. So who can benefit from an offshore company? A non-UK resident investor. As the anti-avoidance rule, that should be ruled, only apply to UK residents or UK ordinary resident individuals. Non-UK DOMs, only subject to inheritance tax on their UK estate. By holding UK assets via an offshore company, they swap the UK assets via an offshore company. That is the shares in the offshore company. The foreign shares would reflect the value of the underlying assets held in the company, which would be exempt from inheritance tax. Persons interested in avoiding capital gains tax could benefit from an offshore company. A multiple ownership. For capital gains taxes only, the anti-avoidance rule applies to ownership of 25%. So the more owners you have with less ownership, the better it is for you. Avoid benefiting from the company. Anti-avoidance rules only apply where the person made the transfer to the company and he or his spouse has the power to enjoy the income from the offshore company. Because remember, it's a benefit. Sound commercial reason. This can be used as a defense. That is, the person can use the offshore company without UK tax being charged on the foreign trading profits. Because you could say it's for sound commercial reason and then say it's for the economic benefit. So there's a recent article, the switch from income tax to corporate tax on their UK property income from non-UK resident companies owning UK resident property. So I gave you some articles. Yes. And they talk about how they're going to change again and tax you some more. You started to read it before they came. So non-UK resident companies carrying on a UK property rental business or otherwise receiving UK property income are currently subject to UK income tax at a rate of 20%. In recent years, the UK government has made significant changes to the taxation of non-UK persons acquiring, holding, and disposing of UK property. In March 2017, the UK government consulted on bringing offshore propcos within the charge to UK corporation tax rather than income tax on their UK property income, with the policy objective of equal tax treatment between UK and non-UK companies holding UK property. Does it sound familiar? So what the OECD said that we need to do?
Yes.
So they had so they had a draft legislation that went out in July this year. So let me see if I can cut the picture where it says.
On the face of it.
Yeah, on the face of it, the switch from UK income tax at the base rate of 20%, the UK corporation tax currently 19%, but reducing it to 17% from the 1st of April 2020 may be a tax cut for some offshore propcos. However, the move from income tax to corporation tax will have a number of implications beyond just the rate of tax. For example, the UK has a new complex corporate interest restriction regime, which to date has not affected offshore propcos within the income tax regime. Very broadly, these rules can restrict tax deductions from interest and other financing costs. Offshore propcos will need to understand and apply these rules once they are brought within the corporation tax regime. Offshore propcos will become subject to the new rules on corporation tax loss relief. Offshore propcos will also be subject to corporation tax in relation to their loan relationships and derivative contracts which they are party to for the purpose of their UK property business. Offshore propcos will cease preparing paper income tax returns for each UK tax year and instead start filing online corporation tax returns in respect of their corporation tax accounting periods.
Something in the box.
Oh yeah, I didn't do the back, I didn't do it two-sided, I'll give it to you. So whilst the cutting tax rates will be welcome, taxpayers need to be aware of the potential increase in tax compliance costs. So the action point is offshore propcos should begin to consider and consult with their tax advisors on the potential implications arising out of the switch from income tax to corporation tax in respect to UK property income. So you have an offshore trust and then you have UK property within that trust or within your company. You're gonna have to pay corporation tax.
Or them not. Because you got, you know what they say, you're making the money from the rental companies, from the properties, you're making the money. So
Mhm.
that's why, and that's how they look at it, and then they say, okay, because they're making the money, let's add another tax.
Mm-hmm.
Yeah, because it joins Excuse me,
So that's, they get all
Income
these money
they
from
join it.
these corporate and the properties and stuff, because,
Because we do this as well, these companies.
so that's just.
Exactly.
Exactly. So, boy, now we can
But
use
this is
that.
how they want us to.
Because
They
we
say,
just,
you know, all
they
that
can be
stuff.
companies,
Yeah.
to put these properties in.
Okay, so turn to the next one. Then finish here.
Sure.
Further UK anti-avoidance rules relating to offshore trusts expected in April 2018. So you see, they first started talking about expected changes to the taxation of non-doms. It was announced in 2015. Remember I told you that? They were passed in November 2017 with retrospective effect to April 2017. However, the government promised as part of the changes to the tax rules for non-UK resident trusts to try to close perceived loopholes. As the legislation is long and complex, some of the expected provisions were postponed and are due to take effect from April 6, 2018. Capital gains tax. At present, gains realized by trustees are attributed to beneficiaries who receive a benefit from a trust, whether the beneficiary is resident or non-UK resident. Non-UK resident beneficiaries are not subject to capital gains tax on trust gains. As such, it is possible to avoid capital gains taxes in some cases by making distributions to non-resident beneficiaries to wash out the gains before making a distribution to a UK resident beneficiary. So from April 6th, this year, capital payments made to non-UK resident beneficiaries will not be matched with the pool of trust gains, and so will not reduce the pool, which can therefore be taxed when benefits are received by UK resident beneficiaries.
Wow.
This means that ability to wash out trust gains will effectively be lost from April. As such, if a trust has UK resident and non-UK resident beneficiaries and has maintained accurate records of trust gains, trustees may wish to consider making distributions to non-UK resident beneficiaries now before the change in the law. After April 2018, it would only be possible to wash out gains to non-UK residents on the winding up of the trust.
They all scurrying around.
Taking the opportunity to wash out gains before then could significantly improve the UK tax position for UK resident beneficiaries in the future. Going forward, it may be worth considering setting up separate trusts for UK resident beneficiaries or creating testamentary trusts, that is trust funded on death for UK resident beneficiaries. Then I give you all the changes, the close family member rules, yes, there are changes. Yep. Okay, so let's see what this says.
Cases.
That's the case I found. Yeah, that's on resident.
No, we're going to the UK.
Why? Formally, see, as of April 2017, an individual is deemed UK domicile for all tax purposes if he, 1, is UK resident and was born in the UK with a UK domicile of origin, or 2, has been UK resident for 15 out of the previous 20 years. Remember that?
Yeah.
The new deemed domicile rules are important in the context of offshore trusts for a number of reasons. 1, once an individual becomes deemed UK domicile, he is no longer eligible to access remittance basis, which means he cannot receive distributions from an offshore trust outside the UK without a UK tax liability.
My Lord.
Under the new protected trust regime, those who are not FDRs and who establish a non-UK resident trust prior to becoming deemed domiciled under the 15-year rule will benefit from a UK tax-free roll-up on non-UK income and all gains in a trust unless the trust is tainted. You told you were tainted already. The trust's non-UK assets will also be protected from inheritance tax, provided no additions are made to the trust. Once the settlor has become deemed domiciled, there will be no tax until a distribution of benefit is received from the trust. So look at you create the trust and then you get no benefit. You might as well just die.
You might as well make sense.
And you might as well spend it while you live With this in mind, it is important to review tax structures before a settler becomes deemed UK domiciled, or to consider setting up a trust for a UK resident individual who is likely to become deemed UK domiciled in the future. Non-UK income arising in a protected trust is no longer treated as a settler's, and so there is no need to claim the remittance basis to shelter his tax income from UK tax. Similarly, gains in a settler interested trust are not taxed as the settlers, even though he or she is deemed domiciled, provided the protections apply. As such, for those who are approaching 7 years of residence in the UK, it may be worth considering establishing a trust over non-UK assets, rather than keeping them in the settler's own name, to avoid paying the remittance basis charge, which must be paid to access the remittance basis after 7 years UK residence. No, they are not playing. You see what it says? To close the loopholes. And that's the way in which they want our government to start to think, to close the loopholes. Huh? You stay right there. They have to get there from a local perspective,
Yeah.
not international law,
No.
locally. They have to tax us.
It's coming.
They can't sustain
No.
the country like this. It's not possible. It's not possible.
I didn't hear that. What she murmured? I know, right?
Then I gave you all a case on, company residence. Read that, cause I gave that to the examiners.
Eh?
I gave them the 3 days.
Hold on.
The 3 days.
Did you hear what?
Same 3 articles.
Okay, great.
And the ones on accumulation trust.
Who?
The
Accumulation
ones we
trust?
read last week,
Okay.
Oh, yeah.
which weren't too hard. What's wrong with your face?
Wasn't too hard, I still ain't get them.
So as you can see, changes are coming. Whoever take this next year will have different changes.
Charlie, the classes.
It keeps changes. It keeps changing.
Okay.
Wow.
It's a lot of changes. Alright?
Huh?
You know,
Oh, let me look back at this. You have to be. These changes. You have money like
Yeah, but see, the thing about it is that if you're operating in many different jurisdictions,
Yeah.
you have to list all the budget communication. You have to read all the draft legislation, and then you have to wait to see which ones take effect,
Yep.
and they keep changing it. They keep changing it. And then when they make the amendments are so long, you have to wait until they tell you what it actually means. Like what are you actually trying to do? And so that's why by the time you figure it out, it's too late. It's time to pay.
You know what you're paying. That's a serious thing though.
Yeah, that's a serious thing.
But some of these taxes, I feel like we could use some of these taxes.
Yeah.
I feel like we could use them. Lord. Jesus. I don't know. Boy?
It's a lot of reading, it's a lot of reading.
It's a lot of read, a lot of yeah, they read. Especially on TV, yeah. That's the connect. You have all the choice. Uh-huh.
And then for tax reasons, the decision is resident. It was like, yeah, I feel like a shadow nominee for a lot of time. Because his money, the tax services, he's resident, the last one they didn't spend here. And now they're trying to close that was cool.
And the money that's really close.
Boy.
It's costing you money, Christmas.
That's what's sad. It's like,
I gotta make a noise. I gotta start.
I started looking.
They gotta start highlighting. Identifying.
This crime.
So I did all those, my fresh fruit and last one. She good.
I think a hole in it.
Thank you.
You have one more class for me to print up?
When that is?
When that is? No, I have to call them and let Miguel.
So Miguel, the tax us.
Email us.
Email.
So Miguel, tell him to come. Which day you prefer? Saturday coming?
No.
What?
They come in.
And initially it was December first, remember that?
It's December first?
They were saying it was December first.
December first? Okay, all right. So I'll send a reminder, so he'll know to come December first. 9 o'clock?
9:30.
9:30?
That's
Okay.
next Saturday, yeah.
That's next Saturday?
Next Saturday.
Okay.
This Saturday.
No, I can't, no, child.
Yeah, I two of us can make December second first, man. You want me to do Tuesday?
Which Tuesday now?
Which Tuesday you talking about? Tuesday coming? Yeah.
When?
I was just gonna say.
Which Tuesday? This one coming? I'll ask him. You want this Tuesday or the following Tuesday? Give him those two options? Or what? Give me the dates.
That's the 27th? That's what you're talking about, the 27th?
That's fine.
So Tuesday the 27th or Saturday, December 1st.
Which day? Well, let me write it down.
That's the date, either Tuesday the 27th
Tuesday, the 27th at 6, or,
or Saturday the 1st.
but two people said they can't come Saturday the 1st.
Everybody can make it on Tuesday.
Mm-hmm.
I guess. I know, right? That's my whole thing.
Okay, well, can they go on the date then?
No.
Which days you're giving me? The 27th or take that out?
So that's just days of
27th
this
is fine.
Saturday.
The
It is
27th?
this Saturday or Tuesday?
I already make. Because
I don't know, more than likely, but.
Yeah, they can record it. So I have Tuesday the 27th or Saturday the 1st?
Yes. 27th.
Okay, I put it there. I'll put this on Miguel desk and then I'll send him an email.
January 6th, you and I.
That's my grandson.
When he sends this information, they will give him a date.
Oh, I know they
Yeah.
January.
Now, I don't know whether what Ryan is doing, whether they have it already. You see what I mean? But I gave him mine now, so he will send mine on to the examiners.
Okay,
And they normally need like 4 to 6 weeks to write the exam.
okay.
So every handle that you gave us is going to have something on that exam.
Oh, I don't know what they're gonna give you,
And just,
but they all would have gone.
Everything you gave us.
It ain't that hard, come on.
No, it's a lot of reading. Yes, it's a lot of reading. I'm not gonna say it's hard.
No, it's a lot of reading.
It's a lot of
I
reading.
could have made it more complicated, but I decided not to.
And those, calculations I need to brush up on.
That's only a couple calculations. I could give you some trust calculations, mine. You don't want them, right?
Good night.
Good night.
you didn't spend that on apportionment, right?
I don't want no calculations.
No.
So we have to worry about that one.
What you mean, send what? On the trust, on apportionment?
Yeah.
From, for example?
Yeah.
Yeah, that's gone.
Say what?
You take that out?
No.
Put that in there?
What that is?
Apportionment.
Good night. What up to you? I'm telling you all, if I send it and if it's to them, it's too easy. Whereby you're just gonna memorize, they're coming back.
You don't have to do it all over.
No, yeah, no, they'll just extend it more time.
extend it more.
Until I send what they think is sufficient. Yeah.
Alright.
So it doesn't make any sense trying to come.
Right.
Yeah. No.